This is Midas Investing, and welcome to the market update for Q1 2023. In this video, we're going to go over the returns of capital markets throughout the first quarter of 2023, as well as go over the status of my portfolio, both the returns as well as the current makeup of it going into the next quarter. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. You may notice that this video is going to have a very different format from the previous market updates we did. That with the changes in my spreadsheet formats that I've done over the last several months, as you can see with my new valuation dashboard, or an image of it that I've shown over the last several months in here. I haven't added in to this spreadsheet the same graphs and charts that were I built up my market updates from last year. So this version of it is going to be a little bit of a patchwork until I figure out a new format for these updates. However, with my recent live discussions that I've been doing on a weekly basis, I have been showing these spreadsheets on a pretty regular basis, including also a regular showing of the returns of my portfolio week in and week out, as well as discussing changes of the portfolio. So the point is that about half of the stuff that we normally did in our update videos have been being done more regularly during the live discussions, and the other half of it, which is talking about kind of the general capital markets, was mostly what I really wanted to make sure I still covered a bit of here today. So getting to those capital markets, starting with the bond markets and the treasury yields, as you can see with this upper left hand chart that we have right here, the treasury yields across 3 months, 2 years, 10 years, and also the 10-year tips, which is inflation protected bonds. You can see the yields are pretty much mostly steady for most of the durations across the quarter, with the 3-month moving up a little bit in line with the quarter hike that we got from the Federal Reserve, but the other durations, the longer durations, and further out on the duration curve it goes, you can see the more so the market has been pricing in eventual rate cuts moving into the future. And the returns that correlate with this in general are likewise with that. You can see for the most part the bond returns are relatively flat, plus a couple of percentage points, which could be for most of the durations of, you can say that that's effectively the yield during this time frame, the exception being the 10-year, which is obviously the longest duration and therefore the most sensitive, having a little bit of a larger return because of the drop in the yield and therefore the rise in price. Corporate yields likewise are relatively flat during the period, with some upwards and downward swings across the durations, and then likewise we can see that kind of variability across the returns by the risk profile designated by the specific index. Overall, bonds have done pretty good in the quarter. And lastly, with bonds, taking a look at the more international profile of bonds here with the sovereign bond returns, comparing the 10-year US Treasury against domestic or developed market government bonds, as well as emerging market government non-US USD bonds. You can see in general the emerging markets have actually done even better, which is what you would expect if the market is starting to price in an eventual return to a more bull run for the bond market in general. The higher sensitivity, higher risk profile of the assets is likely to outperform, relatively speaking. And then coming to the debt premium stack, which I've shown in previous videos, which basically takes the different durations as well as risk profiles across different bond classes, and then places them together and splices apart the different aspects of the yield that are for different parts of the risk. And you can see that the real risk-free rate has actually stayed relatively flat during this time frame, but in particular the negative time premium that we talked about throughout the previous return videos last year, which is negative, forecasting a recessionary concerns in the future due to the mixed match of the durations on the bonds. But you can see that mismatch is actually starting to decrease a little bit in the latter part of the quarter, which is somewhat makes sense. Like I said, with the bonds starting to revert back to more of a normal profile, or at least that's what was expected if the rates are to be dropped in the future. And then moving on to equity markets, the global index return split across by 5 indexes that I like to track, including the S&P 500, the Russell 2000 for US small caps, as well as a foreign small cap index, and then 2 larger and mid cap indexes for foreign markets split across developed and emerging markets. Overall, you can see that it is actually the developed markets and the foreign small cap that have outperformed during the first quarter, which is pretty interesting to see that mix between. Foreign small cap you could kind of classify as being on the higher risk end of the spectrum. Developed markets, though, that one is maybe more middle of the pack, so it's a little bit interesting to see that one, for example, would outperform the emerging markets. If we were expecting a higher risk, higher beta outperformance, then maybe you would expect the emerging markets to perhaps have outperformed in that particular setting. But taking a look more specifically in the US index disaggregated by the sectors, you can see that the outperformance in the quarter is very heavily reliant on technology as well as communications and discretionary. Very, very interesting to see that that's the larger levels of the outperformance. Technology and discretionary very much in line with kind of like a higher beta, higher risk on kind of perspective for the quarter. Interesting to see a communication in there. The communication is a little bit of a mixed bag with just the particular members of that particular index. Some of them are higher beta and some of them are less so. So it's a kind of a little bit of a mixed bag index in particular. The weaker participants of the quarter being energy, which is actually close to flat, but still ends up being kind of the weaker of the groups, as well as healthcare, as well as financials, which should be no surprise, especially for the financials. Now switching over to take a look at the way my portfolio performed over the quarter. In blue is the returns of my portfolio year to date, red being the S&P 500 total return. My portfolio was pretty much in line with the index for the quarter, about a quarter percentage point less so than the index there at the end. I believe the index was up 7.5% and I was up about 7.25%. So just shy of that. While we did have some outperformance earlier in the quarter, but I did manage to mess up some of the execution on parts of my strategy that I think definitely contributed to some of the lower returns in the second half of it. But either way, we kind of ended up in line with the index on the quarter, but always hoping to do better than that. And in terms of overall performance for our portfolio, this is the returns of my portfolio against the same index total return from the beginning of my investing career in 2018. We're still underperforming the index by a total cumulative of around 12% as it currently stands, which is I think it's slightly higher than it was at the end of the last quarter. As I said, we underperformed by about a quarter percentage point on the quarter itself. We got a little bit closer in the mid interim period there, but for the most part, it's about in line with the same level that we've been for quite some time now. But either way, hoping to reverse that at some point in the near future. And then taking those same total returns and converting them into a rolling annualized CAGR for the portfolio as well as the index, you can get an idea of where I currently stand in terms of annualized total returns. The index being a little bit over 10%, like 10.5% or so per year since I started investing, while my own portfolio is at like 8.5 to 9% or something like that, as you can see on the chart. So a couple percentage points per year shy in terms of performance. And then that particular 8.5% per year was also in terms of time weighted returns. So if you also take into account the effect of the timing of my deposits and a money weighted return, which is the green line versus the blue line, you can see the money weighted returns are actually slightly higher than that. Though if you did also do a money weighted return for the index and made a benchmark return, it would also likewise be a little bit higher. So now narrowing in a little bit to get you an idea of what my portfolio is currently constructed and how it's currently positioned for the next quarter, you can take a look starting with my cash levels and my cash target. You can see the purple kind of magenta line is the average cash target that I have for the quarter. I do use a kind of semi-complicated formula to determine a cash allocation target for my portfolio, and then I'm kind of always trying to work myself towards that in terms of selling off some winners or some losers to free up cash to get to the target, or possibly buying up more stocks in order to get down to the target. As you can see, for pretty much the majority of the quarter and some of the last quarter, or pretty much all of the quarter and some of the last quarter, I've had more cash on hand than my cash target, pretty significantly so. My cash target currently being like 16, 17% or something like that. And my cash levels there at the end of the quarter was at like 21, 24%, something in that range. I think it was at 24%. Although in the last couple of days, I've actually literally already dropped it down by a little bit more. And then likewise with my estimates for cash levels, I also make an estimate for the returns for all the positions in my portfolio. And then I combine all these together to come up with an expected 5-year return for my portfolio. Which you can see over the last quarter and also into this quarter has been dropping like a rock from the kind of teen levels, now down below 10%. It's at like 9% or so expected return. Now it's to be understood that this expected return assumes effectively that I'm going to leave my portfolio alone and come back to it 5 years later and not be doing any sort of active movements within the portfolio, because obviously I can't really account for the movements of the of my own actions when it's related to actions within the market. But it's worth noting that this relatively low expected return is also a result of having those much higher than targeted cash levels. With, if I'm going to have about a quarter of my portfolio in cash, that portion of the portfolio has an expected return of 0 because it is part of the portfolio. When I say expected returns, I include that cash. That cash is part of the portfolio. So it's worth noting here that it is a low number, but if I was to put all of that cash to work, maybe just weighting it by the current total portfolios, then it would jump back more towards like 12 or 13% or something like that. So point is this is just a sign to me that I need to get that cash to work. And now taking a look kind of like at the actual composition of the positions in the portfolio, looking at kind of the concentration levels. This is a measure of the portfolio concentration over time, where you can see in the blue the weight of my top portfolio holding by portfolio weight, which over the last quarter actually did change from Fidelity National Financial, which had been one of my most major holdings for quite a long time in my portfolio, to now Smith & Wesson is now my top holding at currently, I believe, around 9% of the portfolio. And then it also shows the cash levels in the orange there at the top, which with the weird little divots where it has the white there, shows periods in which I technically had negative cash on hand when I was using margin, which is why the chart is a little bit strange at those points. And then the other portion, the purple with the number associated, shows you the remaining positions and then the percentage of the portfolio that they make up. So you can kind of get an idea of just how much weight the rest of the positions hold. For like, see the majority of this chart, it's something maybe around 20 to 21 positions that are making up something like 70 to 80% of the portfolio, which right now you can see that it's actually 15 positions there at the end, with maybe a little bit less, maybe closer to that like 70% line of the portfolio. So you can see that maybe my portfolio, there's a smaller position count currently, and we're kind of getting a little bit more concentrated, but not concentrated more on the number one holding. We're actually starting to broaden out that concentration into the secondary holdings a bit more than normal, which is actually kind of what I've been hoping to do. So we're doing good in terms of that portfolio concentration measure. And now this next chart is kind of an interesting one, something I've just kind of been trying to pay attention to in the back of my mind a little bit, but I put together a chart of it showing the level of which my portfolio overlaps with the S&P 500 in terms of positions over time. This is something that I personally try to think about. It's like I'm trying to beat the S&P 500 in terms of returns, but my personal portion of the goal in there is that I'm trying to beat the S&P 500 by not cloning the S&P 500, and that's partially because I want to actually say that I was actually selecting companies and not just like picking companies that people kind of obviously think of as successful companies, which are the S&P 500 is generally thought of as obviously good companies, blue chip companies, so to speak. But also I think it's kind of hard to beat the S&P 500 if you're effectively cloning it. So I pay attention to how many of the companies, the positions in my portfolio are members of the S&P 500 versus not. And you can see here that about 25% of the positions in my portfolio are members of the S&P 500 versus not. And last but not least, we'll actually take a brief look at the overall allocations of my portfolio here by market weight. As I was just saying, you can see Smith & Wesson is the number one position in my portfolio at just under 9%, with Meta being the number two position by market weight, just under 8%. Samphire Resources still in the top 5 positions at about 6.5%. Interfor Forestry at about 5.5%. Followed by Hibbett Sport, which is a little under 5.5%. You can see the remaining of the handful of positions right here, as I was kind of just saying, they're starting to kind of become respectable slice sizes themselves, what with the kind of narrowing of the total position count, as I was just talking about. We also have our alternative strategies, including bond ETFs, corporate workouts, certain select equity ETFs, gold ETF, as well as put options. And then as you can see here are very, very large amount of cash on hand, which, like I said, I very much hope to put about a third of that to work in as fast of order as I can, of course, opportunities willing. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it for our Q1 market update. As I said at the start of the stream, we're kind of in a little bit of an in-between period here on the channel. What with the changing of formats within my spreadsheets is with also the overall layout of the video content that I've been producing. So with the next quarter update, it's very possible that we'll be changing up exactly what we're doing a little bit more as I probably integrate some more of these charts back into my spreadsheets again. So I'll catch you all in the next one. Bye.